You are all attending a conversation where we're going to be talking about the unforgiving industry. And I think the reason we had so many people sign up for this is because everyone's like, yeah, this is an unforgiving industry, but what are these guys going to tell us? And so the other part of this is what can you do to catch the double wave? And before I introduce our speakers here, let me explain what the double. You may already know, but if you don't know what the double wave means, you've heard it in the industry a couple times said now. The double wave is refi and purchase. Right now, you're having a boom in refi still, and you're having a boom in purchase still. Right, even though refi may have gone down a little bit, you'll see that in just a moment. You're still having both. So, what can you do to catch this double wave and ride it out? And there are going to be three of us that are going to be talking about this today. Rob Chrisman, as you all know, there he is right there. You have Mike, a friend Tony, correct, Mike? Did I say that right? Perfect. The chief economist over at the MBA. And then you have me, Alex Kutsishin, CEO, founder of Sales Boomerang. And we're going to bring this to you. And again, if you've heard some of the conversation we've just been having, that's what we're expecting the entire conversation to be like: conversational and educational and a little bit entertaining. Before we get right into the topic, for those of you that don't know who Sales Boomerang is and why I'm so honored to be here with these two, let me explain to you what we do, a little bit about who we are, why we're here, what we're about. I kind of laughed about this earlier. We kind of sent out all these invitations and promoted it, so most of you maybe know who Sales Boomerang is, but maybe you invited friends and people who you believe should be here that don't know who we are just yet. So Sales Boomerang is the number one automated borrower retention and intelligence system in the country. As you can see, some of the cool stats here. What we do is we let you know about what's happening in your database. We tell you when anyone in your database is ready for a loan and what loan they are ready for. And the crazy, shocking number for everyone on here that's seeing this for the first time is, yes, you could get as much as 13.5% of your database having an event that's related to mortgage every single month, which means there's more than 100% of your customers potentially that could have an event every single year. So it's very important to understand your customer base and understand how you can serve them. And you'll find out in this conversation specifically how now, and I know it's like, oh, Alex, every time you're going to say it's now is the best time. No, here's the thing. Right now, timing is everything. Events and making sure that you're there for your customers is everything, because we're in a very unique environment for the time being. And so timing now may be more crucial than ever. We're going to get into that in just a minute. But you can see all the different things that we can help you understand about what's happening in your database and your customers, everything from, credit improvement opportunities to somebody that's qualified to remove their mortgage insurance right now, right? And so let's start with some charts. You guys are about to see a lot of charts in this presentation, and it's going to be really cool stuff. There's some really interesting insights. This particular chart right here is a Sales Boomerang specific chart. This is everything that we track for our clients, nearly 7 million, maybe I think we may have broken 7 million records now under management for our clients, for the lender partners that we work with. And what you're seeing here is an interesting chart where we're comparing October to December. October timeframe, October 2020 to December 2020, and January 2021 to March 2021. And what we're looking at is sort of the difference, what a little bit of time can do to what's happening inside the industry, inside your database specifically. So a couple things to point out. First of all, very interesting thing to notice is there's a lot less listings than at the end of last year. You can see that. There's a real reason for that, right? It's not that people don't want to sell their homes and buy new homes. You're going to hear us talk about this. There just isn't enough supply. So they're not listing their house if they haven't found something. So you're starting to see this trend where at the end of the year, everybody was listing their house, taking advantage of the high prices. And this year, the people want to do the same thing, but if they can't buy something, they're not listing theirs. And so you see that very interesting statistic that listing is actually down this half of the first quarter of the year. And many of you may be like, no, they should be way up. And theoretically, you are thinking that, right? But the truth is, inside our clients' databases, this is exactly what we're tracking right now. You're also seeing mortgage inquiries are down a little bit. That has to do with a little bit of the refi drop, right? But also the fact that there isn't that housing available on the market for everyone. Something that is not a shock to any of you that you'll see this. This is really, really cool. Right in the middle of this graph, equity. We all know this, but let's just confirm that this is true. This is records inside our database for our lenders, and equity is through the roof. There's more equity in your databases than you've ever had before. And then the last thing, which is very interesting, and then we'll move on, hand it off to Mike and start the conversation about what's happening across the markets, not just of what we're seeing inside our own database here. And by the way, if you have questions, guys, remember, interactive, talk to us. If you have questions about this particular chart, ask. If we can't answer it now, we'll get to it at the end. The credit improvement. You see that the second chart says credit. That stands for credit improvement. How many people in our clients' databases improve their credit, right? In a certain time frame to be able to be qualified for a mortgage. What's interesting about this statistic, very interesting about this statistic, is you can see at the end of the year last year, more and more people in your database fixed their credit. Why? The story is kind of simple. I want to take advantage of these low rates. I want to be the one that refis to the lowest rate possible. So you see everyone trying to do everything possible to fix their credit. And this year, you're not seeing that same activity. Again, we're predicting, our thought is it has to do with the fact that number one, a lot of people already fixed their credit, took the loans that they're going to take, so that they no longer have to fix their credit. And two, there's, as the rates start to creep up, people aren't as excited or aren't as eager to get their credit up so they can get the best possible rate. So this is our own internal findings. Now let's turn this over to Mike, and let's talk about past, present, future. Mike?
Thanks, Alex. And again, thanks for the opportunity to talk to this group today. But let's just go ahead and jump to the next slide. You guys caught me at a good time. Last week, we just put out a revised update of our forecast for April. We had the spring conference for MBA last week. And I think the thing to highlight is that we are just in this period of transition right now. So 2020 just really consumed by the pandemic. 2021, it's all about getting the vaccine out to as many people as possible. Now you have more than half of adults who've gotten at least one dose, and hope everybody's out there doing their part as well.
Mm-hmm.
So improving. In terms of the broader economy, last year was the steepest recession we've had going back to the 1930s. This year is probably going to be one of the strongest recovery years we've ever seen. So, showing GDP growth of 6.5% for 2021. That is a very, very high GDP number for a full year. That's going to bring the job market back extraordinarily quickly. So you saw more than 900,000 gain in employment in March. I think over the next 6 months, you're going to see numbers like that or even higher over this time period, and that'll bring the unemployment rate down from, it was 6% in March, we think about 4.5% by the end of the year, so averaging 5.3 for 2021. So a very, very sharp recovery. That's all positive for the housing market, because that means more folks feeling confident enough to go out and buy a home, having that stable employment they need. But the flip side of that is the recovery and the expectation that at some point, the Fed's going to start moving away from some of the extremely supportive measures they put in place that have kept rates low. And that while Congress, the administration have passed a number of pieces of legislation to provide a lot of fiscal support to households and businesses, going forward, those are going to be a little tougher to continue to move. And we're already at a place where federal budget deficits are particularly large. So our expectation, to your point on the slide, is we're in an environment, improving economy, improving job market, and expectation of some of the policy support beginning to move away, that we think rates are more likely to go up than down. So in terms of a 10-year treasury, that means going from 155, 160, where we are today, to about 2% by the end of the year. And in terms of a 30-year mortgage, we were at about 3.2 last week. We think 3.6, 3.7 by the end of the year. So if you didn't have 2020 to compare to, 3.7 mortgage rate looks really pretty low. But last year, obviously, we were well below 3% for a good part of the year on a 30-year fixed rate. that makes an enormous difference. So if we move to the next slide, here's what we think the impact of that transitioning environment is going to be for the mortgage market. So 2020, by our latest reckoning, was an all-time record in terms of origination volume, more than 3.8 trillion, even bigger than the 2003 year, which was the prior record. That was almost 2.4 trillion in refi, 1.4 trillion in purchase. So mentioned, again, our expectation, we think mortgage rates are going to go up for all the reasons I mentioned, and expect that is going to lead to a decline in refi, particularly as we get into the second half of the year. So we think, in our latest estimate, about 1.6 trillion in refi in 2021, almost 1.7 trillion in purchase. So that combination of a very strong job market, rates which from a historical perspective are still low, phenomenally supportive demographics as millennials are hitting peak first-time home buyer age, all that pushing purchase volume up. That 1.67 trillion, that's the highest purchase has ever been.
Wow.
We expect in 22 and 23, you see those green bars, it's higher.
So Mike, can I jump in here? We had Tom DeLeo just asked a question. He said the 10-year treasury at 2.6, and he put question mark. I'm wondering what he means by that. Do you want to see if you can help him understand?
Yeah, if you go back to the previous slide, I'm believing he's pointing to our 2022. So our forecast is end of 2022, we see the 10-year treasury getting to 2.6. So thinking about over the very long term, 3-4 years from now, the Fed will be bringing short-term rates back to sort of the equilibrium point, which is at about 2.5, and 10-year treasuries somewhere between 3 and 3.5 is probably where they'll level out. Everybody experienced that fairly rapid run up in longer term rates earlier this year, coming from the results of the election, particularly the runoff election in Georgia, which led to one party control of government, expectation things were going to move through more quickly, and they have. And then just a series of economic data which have come in stronger than had been forecasted. So this transition period I'm talking about really moving much more quickly back to not normal, but normal is within sight now as opposed to being out of 6 months ago.
Excellent.
Jump ahead too.
Yeah, I'm going to jump ahead too. And by the way, I also want to mention that Joe had a great question, but we're going to get to your question at the end. I think it's perfect towards the end of this conversation. Let's keep going.
Yeah, so just to the rate conversation. So that the green line here is our expectation for that 10-year treasury. So again, getting from where we are today, 155, 160 to 2 by the end of the year, and a little over 2.5 by the end of 2022. And you see the mortgage rate at this point now moving pretty close to 1-to-1 with that 10-year treasury. I'll come back to that point in a minute. Mm-hmm. But I mentioned the Fed. So the Fed really has two things going on here. The blue line shows the Fed funds target, which is an overnight rate. That's typically been their primary instrument of monetary policy. They control a short-term overnight rate. They have committed to keep that at 0 all the way through 2022. And in their latest projections, we are going to agree with them. We think they're going to begin to hike short-term rates in 2023. We think twice. But big takeaway there is short-term rates sort of locked in as low as they can be the next couple of years. But that's not all the Fed's been doing. The Fed has also been actively working to keep longer-term rates down. So they have an enormous balance sheet now, north of 7 trillion, and they're adding to that balance sheet by 120 billion per month. They're buying an additional 80 billion of treasuries, 40 billion of mortgage-backed securities every month, sort of month in and month out. Initially, during the worst of the financial market disruption last March and April, that was just to keep markets going. The Treasury and MBS markets had locked up. You needed a big buyer in there to just get the securities flowing again. But since then, they've changed the way they talk about it and think that this is another means that they can use to support the economy by keeping longer-term rates lower than they otherwise would have been. Here's the trick. While they've committed to keeping short-term rates low for years, they have not made the same commitment to keep their purchases going. Mm-hmm. What they've said is they're going to keep those purchases going until they've made substantial further progress, and that's the term of art, towards their employment and inflation goals. So they want to get unemployment from 6% where it is today back down below 4.5%, which is their goal. And they want to get inflation right around 2%. They actually are going to allow it to go a little higher than that for a time. Now, if my forecast is right and we're 4.5% by the end of this year, that's substantial further progress. And that means they're going to start cutting back on those purchases. And if you go to the next slide, sorry, don't have this one. If you remember what happened back in 2013, they were in a similar predicament where they were making these quantitative easing or QE purchases. In May of 2013, then Chairman Bernanke just hinted that they might start tapering, and longer term rates jumped just at that news that they were even thinking about it. So Chairman Powell has been extremely cautious and saying, we're not even thinking about it yet. When we get there, I'll let you know. I think many market participants are beginning to think that's going to happen maybe this summer or early this fall. Not that they're going to start tapering these purchases, but they're going to start talking about it a whole lot more. So I think, Rob, anybody in the capital market space I think has to get ready for an environment that's just much more volatile when it comes to rates, because as they move from this, we're not thinking about tapering to, yeah, we're going to taper pretty soon. You're going to see a market reaction then, not when the tapering actually occurs.
I'm going to have to remember that one, Mike, not thinking about it. That's good. That's a good one. That's a good one to remember. Rob, you have anything on that?
No, that's a good line to use on small children. You know, I'm thinking about coming up there. So far, Mike, I'd say you've been spot on in terms of what's going on in the economy and so forth. I think, and especially with regard to the Fed, I'd say the Fed is much more transparent than it was, years ago. In fact, unless they're in a blackout period, you've got 2, 3, 4 Fed presidents speaking on any given day, and so they've been very open about what they're thinking about. It's been educational. It's been fun to watch, and it's taken a lot of the volatility out of the market. I did want to ask you, because I'm asked this somewhat, rates shot up back in, after the election, as the election was decided, rates decided to go up, and now they've drifted back down. In fact, my daughter a couple weeks ago got a 2 3/4 30-year fixed rate mortgage.
Wow.
So there you are. We're back in the high 2s, if not the low 3s. And so rates have drifted back down. And I think that it's important for you to remind folks that even though we're talking about some forecast at the end of the year, or 2.6% at the end of sometime in 2022, it's important that it's not a straight line. It's up and down, fits and starts. And maybe you can tell folks why, from an economist perspective, why rates kind of shot up in January and February and have come back down, just why that happens naturally.
Yeah,
great question.
Yeah. So, longer term rates are capturing a couple of different things. One is the market's expectations about where the Fed's likely to take short-term rates. So it's just really a predictor of future policy. It's also reflecting overall strength in the economy, the real side of the economy, how fast it's likely to grow over longer periods of time. It's also capturing market expectations of inflation. So anything that changes the likelihood that inflation is going to run faster or slower going forward is going to show up in the level of long-term rates. And then finally, just like anything else in economics, right, there are supply and demand effects. So if there's a belief that the demand for treasuries is going to increase because the Fed says they're going to buy 80 billion of them every month, or the Bank of Japan or Bank of China says they're going to buy more or less of them, right? There's those kind of factors as well. That's on the demand side. On the supply side, if the government's running a $3 trillion plus deficit and the Treasury is going to have to auction that amount of securities in addition to what they need to roll over existing debt, that's a lot of supply coming on. So all those factors weigh into what longer term rates are telling you today. So in terms of what happened this spring, sort of my thinking is it was a combination of data coming in saying the economy is likely to return to normal faster than any forecaster had predicted. So that's pushing upward pressure on rates. A lot of information showing there was going to be a pickup in inflation, at least over the short term, because of all these supply chain constraints worldwide in just about every sector of the economy. And then you have things like the American Rescue Plan passing Congress very quickly, an additional almost $2 trillion added to the deficit. So just to those technical supply demand factors. So, all of that, very quickly changing investor perceptions. But then within the past couple of weeks, those perceptions are changing again, right? A lot of that, I think, reflecting, you look at the news coming out of India or some other countries, that the intensity of the pandemic picking up again, and that while the situation in the US is improving quite a bit, and our economic prospects, again, certainly look very, very bright, given how quickly we've been able to vaccinate the population. If some of that news out of India and elsewhere is suggesting that the global pace of growth just is not going to pick up the same way the US pace of growth is going to pick up, I think that's what's been hitting rates over the last couple of weeks. Does that make sense, Rob?
It does make sense. Thank you. And I think it's important for viewers to remember that we can sit here and you put together some very reasonable expectations and forecasts and so forth, but suddenly, a ship gets wedged in the Suez Canal, or North Korea fires a missile in Hawaii's direction, or China starts saber rattling. There are things obviously beyond the control of our Federal Reserve and our economy that will impact our economy and in turn impact rates. So yeah, you summed it up very well. There's all kinds of things. It's good to keep your knees bent if you're a lender or a loan officer, and be ready for the next punch. It's nice to have a fight plan until you get hit by that first punch, as the saying goes. So yeah, there are all kinds of things which makes your field fascinating, right? Yeah. You never know what's going to happen.
Then I think particularly with this episode, the fact that, a vaccine all of a sudden has a side effect that hadn't been anticipated, right? I mean, that certainly has impacted global results over the past couple of weeks with the J&J and AstraZeneca concerns, right? And those are things that, honestly, as an economist, you don't think you got to worry about vaccine test results, but in this case, that is front and center every day.
Absolutely, and the tail that I've grown since my second shot, I try to hide it from calls, but it gets in the way sometimes.
Thank goodness we're on Zoom and not live, right? All right, let me walk through my last two slides out. I think that'll feed through to some of Rob's discussion. So we go back one. This is
go back one.
Go back one. This is what I think is one of the really most interesting aspects of this particular cycle. What am I showing here? The blue line's the 10-year treasury, the red's the 30-year mortgage, the yellow is the spread between the two. So typically when we're forecasting years ahead, what we think this spread is going to be 170, 180 basis points. That's typically what it's been about average. You look last March and April, it was 260. So I mentioned the market was so disrupted, the Fed felt compelled to come in, full force to try to support it and get it functioning again. And I think as every lender on here knows, through the course of 2020, that spread strayed extremely wide, and that showed up in fantastic gain on sale revenue for almost every lender, right? And it really was reflecting capacity constraints that the industry was facing, seeing this record level of volume, challenges hiring new staff when everybody's remote. But the thing that struck me that was so interesting is you look about November, that spread started coming in, and it started coming in very, very quickly. And it got to a point where, we've gone through that 180 and 170 range, which I would describe as more typical. And that's when I started saying, even though we've had this couple of months where treasury rates were going up, but mortgage rates were flat or going down, I was like, I don't think that's going to continue very much longer, because spreads come in too much more, that margin's effectively gone. And so I think, we're going to reach a point where mortgage rates are going to have to respond to further increases in treasury rates. And we got that, but spreads have kept coming in, by this measure, 150, 155 or so. So we're back to sort of 2018 levels. This is a very crude measure of a spread, right? But it's a nice real-time way of looking at what's going on. But when I talk to lenders across the industry, this is what's getting people's attention, right? Not that it happened. Spreads always come in when refi volume falls off, but the speed with which it came in, this is the unforgiving nature of this discussion, that you got to be ready to make decisions pretty quickly when the market can turn on you as fast as it did. And if we go to my last slide, just a more formal measurement of a margin. This is from our quarterly performance report, looking at revenues minus fully loaded expenses. This is shown as basis points of production. This is averaged about 52 basis points going back to 2008. You can see in 2020, it was a phenomenal year, not just in terms of record volume, but margins being much wider than typical, 203 basis points in the third quarter of 2020. They came in fourth quarter, but if my expectation is right, based on the prior slide, that with mortgage treasury spreads coming in, revenues coming down, expenses probably not moving too much in first quarter, expect that this margin probably came in first quarter and, getting even more pressure as we go into second. So let me pass it over to Rob, see if he had thoughts there.
No, obviously a fantastic year, and I've been making the argument that it could be the best combination of volume and margin that we've ever seen. And you're right, Mike. The fastest way to adjust volume is by price, and we're seeing that everywhere. And the interesting thing, or there's lots of interesting things about it, but when you talk to lenders as we went through 2020 into the first part of 2021, this isn't a surprise. Not only the profits that we saw, but the fact that at some point as an industry, lenders will start to cut margins a little bit or a lot. And so when you look at some of the moves that we're seeing now with companies that are out there, the correspondent channel has always had historically thin margins. So people wonder why would you ever want to cut your correspondent division? Well, the margins aren't great. Yeah, you can get a lot of volume in a hurry, but it's not a high volume or a high margin channel. Wholesale, the margins are a little bit better, but brokers have always been very astute about shifting their business based on price and product and to some extent service. So they're quick to take advantage of margin issues. And then lastly, retail, and the retail side of things could explain why so many banks are in very good shape as we head through 2021 here, because so much of their volumes do come from the retail channel, and retail channel tends to be a little more squishy versus wholesale or versus correspondent in terms of margin adjustments that have to be made. So yeah, the profits from last year are good. The question that I'm hearing or that I'm being asked is, what are companies doing with those profits? Are they going to go public? Are they going to buy another company? Is the money ending up in the owner's pockets? Were they paid out as bonuses? Are they reinvesting that money into technology and training and so forth? So that's kind of the $64,000 question. So just a great year for profitability, and I don't think anybody expects it to continue in 2021. But there are some profitable products out there that companies are taking a look at if they're not already offering them.
Yeah, well, and what you're saying, Rob, and what you brought up about companies going public, there was a great question that was asked that we'll get to in just a minute here, Joe. Let's dive into a couple of these things. and a couple of these specific questions here, because look, we're talking about an unforgiving market and taking advantage of this thing called the double wave and how you can catch it, right? And so here we are. Mike, that was amazing information, honestly. And the way you deliver this information is so concise and so sticky and easy to digest. It's fantastic. But Rob, let's start with you here. And then, of course, Mike, jump in. How long will there be this double wave? And again, a reminder for everybody, what is a double wave? For those of you that just joined or have been joining as we're talking, I see the numbers keep rolling up. A double wave is the refi and purchase boom, if you will, right? So both channels there, both the refi opportunity and the purchase opportunities are alive and well. How can you catch both of these waves, and how long will they be around? So Rob, what do you think? How long will the double wave be here?
What time is it? No.
On the East Coast or where you are? In the future?
First, I want to come back to Mike. And all kidding aside, I think Mike and his team do an excellent job. And Alex, you stated that as well. I think they do an excellent job in terms of addressing the questions that lenders have. You know, when you hear from some economists, it's all about, personal income, consumption, and what do we think, the Philly Fed is going to, what measure is going to happen there in 2022 and so forth. Mike and his team do a very, very good job about taking that information and distilling it into information that lenders can use, that lenders can present to their owners or their board of directors. And I don't think that is an easy task. So Mike, once again, hats off on the job that you guys do.
Thank you.
And I think that you are spot on. And Alex, to your question is, how do you use that information? If you're sitting here and you're an originator on this phone call, or you're a manager, what's going to happen? How do you keep your knees bent? How do you react to this, or do you act first? How do you take the lead? In terms of refis and purchases, when I talk to certain loan officers, they, the successful ones pay attention to the things that Mike and his team are talking about. They pay attention to what's going on in the Suez Canal, or pay attention to toilet paper shortages, or whatever might be going on out there. But they continue to help borrowers, one borrower at a time. And whether it's a refinance or a purchase, it almost doesn't matter. But what I am hearing sales managers stress is, you guys and gals should not have forgotten your realtor clients, your real estate agent clients. You shouldn't have forgotten your financial planner clients. Sure, there's a lot of easy fruit hanging from trees. Sales Boomerang does a fantastic job of alerting loan officers, loan originators as to what the potential is out there. The question is, how do you go out and get it? Focus on your referral base. Don't be afraid of writing a little, a 2-minute thank you note and throwing that in the mail. It goes a long way. Don't be afraid to, visit real estate agents. And granted, they might not have the full offices that they used to, but they're starting to come back into the office. Don't be afraid to make your presence known. Remind them of who you are, and remind them of your value. I think that's the biggest thing that I hear, and I keep mentioning this to audiences, is know your strengths. You are a subject matter expert. The people on this phone call, to a great degree, are subject matter experts that can say, here's what you need to do. Throughout 2020, I saw repeatedly instances where borrowers relied on their local loan officer, or a loan officer that they knew. They relied on that human touch. The loan officers were able to focus on their strengths. They were able to, that they know how to communicate with their clients, whether it's text or an email, or a recipe for Halloween, a recipe for pumpkin pie at Halloween, whatever it is. They're good at communicating, and they're good at answering questions. And granted, a lot of people can go on the internet and search, what is an escrow holdback account, or why is my appraisal taking so long? But people wanted somebody to explain that to them. even if they're in their late 20s and early 30s, they soon find out that push a button, get a mortgage isn't quite how it works, and they needed that human touch to rely on. So when you talk about a double wave, refinances and purchases, the loan officers, sure, the refis have really, made for some great years for a tremendous number of loan officers out there, making more than $1 million of income, which might have been unheard of a few years ago. But they never turned away from purchases, despite inventory levels being low, despite bidding wars, despite all cash buyers. They still tended to focus some of their attention on that, and that's what I'm hearing, happening into 2021 and probably for the rest of 2021 and beyond, is a loan officer's ability to not totally ignore one segment or the other, but to be able to adapt to buyers and helping realtors and being out there for those clients, especially first-time home buyers, but also, not turning away refi calls that can really help their bottom line.
I love what you're saying, Rob. Honestly, this to me is such, and it's a big misunderstanding for me personally, Rob. I talk to a lot of organizations, and I won't mention any specific names, but I've heard so many times, oh, we just do refi or we just focus on purchase. And it's like, so if someone calls and asks to do a refi, you're just going to say no. Yeah, I'm not really that interested. Like we hear this, and it's not from an originator. It is from an institution. So it's top down. And so I love what you're saying. It's like, look, be the advisor that you claim to be. If I need a refi, help me. If I need a purchase, help me. And I love that. And I also love the fact that you said, look, there's all this tech. As a CEO of a technology company, I love that you said use some organic grassroots approaches. You want to stand out. You want to be different. Don't email people all the time, right? Don't use technology. You want to be different now, use an old-fashioned approach, like writing a note, like coming in and seeing somebody in person, right? That does go a long, long way. So I love how you weave that together.
It's interesting how a few years ago, as Rocket and Quicken started to really speed up and grab market share from other institutions, there was a school of thought that said, oh, they are a refi shop only. Just, when refis go away, they'll go away. The fact of the matter is, I think, say what you will about, Quicken and the Rocket organization, but Quicken, they have done a very good job of inserting themselves or putting themselves in front of borrowers and in front of first-time home buyers.
Yes.
And I think that has benefited their purchase volume. So it's not impossible for companies to change or for individuals to change. It's a matter of saying, okay, I need to take a look at these down payment assistance programs again. It's been a while since I dusted them off the shelf. Hey, it's good to see what my company has in terms of bond programs. What's going on out there, and present yourself once again as a subject matter expert to people out there, whether there are referral sources or whether they're real estate agents, to say, hey, we've got this down payment assistance program. I think I'd like to tell, give me 5 minutes of your time. I'd like to tell you about how it works. Or, hey, we just rolled out this new bond program, and it's pretty nifty. I don't know if people use the word nifty anymore.
I think you're the last one to use that word. Yeah.
Dating yourself, man.
So yeah, I think once again, keeping your knees bent and being open to these things. And to your point, being able to use technology or not use technology.
Right.
Or better yet, find out what technology your company already has before you start saying, we need this and we need that, because your company may already have it. You just haven't looked at it, or you haven't been trained yet on it.
So Rob, I got I want to take this off because it's not going to be a question that we put out there. But we had two great questions. Bob, I'm going to get to yours in just 1 second. By the way, Rob, people are laughing at the word nifty. I just want you to know. and we're going to get back to that too. We're going to laugh a little, but Joe, I'm going to go to your question first, because I thought this was a great question. And then we're going to go to your question, Bob. So Joe was asking, now that we have public mortgage companies for the first time in a while, are you finding anything interesting in looking at their filings? Like, is there any reason to look at their filings and that they've gone public? Is there anything interesting to look at? Let's start with Mike, and then we'll go to Rob.
Yeah, certainly. We dig into those, but we're data junkies here at MBA. So, we not only have the applications data, the delinquency data, we have the benchmarking data that Marina Walsh and her team put together through the performance report, and then the peer group roundtable program that we do jointly with Stratmore, and Rob's involved there as well. So having some of these companies that we're able to take an even deeper look at through the public filings, it's fantastic. One of the things that's always been interesting in our peer group roundtable program is looking at the way banks view the mortgage business versus independents. And, for banks, oftentimes the mindset is that mortgage is a product, and the product does well sometimes and it does poorly sometimes. And, they try to position themselves to do well over time. With an independent, it's not a product. It's the whole shebang. It's business. And so you can't lose money the way a bank might lose money in their mortgage business for a period of time. And so it's a very, very different mindset. And so I think these independents who have recently become public, that's going to be a very tight discipline, I think, in terms of how they allocate their capital and how they think about the business going forward. But again, I think, as Joe said, this is a new experiment to have this many large independents going public at the same time.
So let me ask you this, Mike. If I'm an independent and I'm looking at these filings that are public, what are like the one or two things I should look at first? Like, what's something that should jump out of the page on me and be like, wow, I need to internalize this and bring this to my team? What are some things I can look for in these filings that are important to me?
Well, it's interesting, man. I think that the way Rob was talking, when you get two lenders together and then you ask them to describe their business, they talk about their channel mix, they talk about their conventional govy mix, they talk about refi purchase mix, and then they talk about maybe some of the technology choices they've made. They do talk about some of the key staffing challenges they might be having, and then when it comes to business metrics, it's things like productivity, right?
Mm-hmm.
What's your average loans closed per LO in a month? How many apps are your underwriters working through in a given month? Those are some of the key productivity metrics. And then the one that I always focus on is cost to originate, because I think that really is the key driver about whether a lender can be successful over time. Is, can they maneuver that cost to originate on a sustainable basis below what they expect their revenues to be? Because again, you need to be profitable all in at the end of the day.
It's so that metric right there. And it's so interesting that sometimes when we talk about this, Mike, and we hear people go, I'm not sure, or it doesn't seem like it's the most important thing. And to us, when Sales Boomerang says, hey, you can cost to originate to keep this low, it's surprising how many people say, all right, well, what is the cost for the lead? It's like, well, hold on a second. Let's look at the cost to originate, right? Like, that's got to be the most important metric for you. Because if it costs a penny, but it costs you 100,000 to originate one, it doesn't matter. Like, the lead, you can get 1 million leads if you can't close one. Right. So I love that you're looking at that metric. Now I'm going to ask one more that's off the books, not what we planned to ask. And then we're going to jump into some of the ones that we did have lined up to ask. Bob asks, what are your thoughts about the industry reducing the capacity, human capacity, as the volumes start to decline? What are your thoughts on the industry starting to really, let go of some of the staffing they brought on? What do you think is going to happen? Rob, maybe first?
First, or?
Up to you, Mike.
Yeah. So, I mean, my thought is, you saw the origination forecast we have out there. So I think, to Rob's point, of you have some lenders that have been more refi focused, would not be shocked to see them starting to cut back on staffing. But for those that were majority purchase last year, and there are a lot of lenders like that, and we're going to see a record purchase year this year, they're well positioned to grow. So I think it all depends on the business model, the choices people have made going in. I think, to Rob's point, it is a challenge to sort of switch midstream. You can't develop those referral relationships overnight. That's the product of years and years of work developing those relationships. So there are going to be some folks that are better positioned for a purchase dominated market going in.
Great answer. I love it.
Yeah, I'd add a couple weeks ago, I was talking to the owner of a relatively small company, a lender, more focused on the West Coast, and they probably do maybe 20 or 30 million a month, so they are small. And I said, "So how's it going?" He goes, "Well, I just got out of a meeting with my president, and we've got the first RIF plan, reduction in force plan." This was a couple weeks ago. And I said, "Wow, holy smokes, kind of quick to pull the trigger." And he said, "We just can't afford to have people on the payroll because it's expensive. We had to staff up. We had to find underwriters where we could last year. The ops staff or the operations, the gamut of operations positions were really calling the shots to some extent in many areas in terms of scarcity and in terms of retention bonuses and so forth." And he said, "We just don't. First of all, we've cut overtime. We did that a couple of weeks ago. We've cut overtime and no more overtime, and we've got people in place that, and frankly, it was more the LIFO style that he was looking at. Our headquarters are in this city, and at some point we expect people to come back into the office. So we don't need an underwriter in New Brunswick or one up in Manitoba or Montreal. We want people near us, and so the people that we had to hire to get through the glut of last year, they'll probably be looked at pretty closely. Productivity obviously matters, but really when you talk about layoffs and so forth, yeah, it's a cyclical business. Anybody who's been in this business for more than 5 or 10 years knows that it is a cyclical business, and the lower cost producers will be the ones that do well and survive. And Mike mentioned purchase versus refi. That does matter, and obviously purchase or the obviously product mix is a huge part of that, because FHA and VA, some loans are known to be more profitable than others, and so a company that focuses more, say, on government lending might be more profitable, might be a little slower to cut staff. Others that are more Fannie Freddie and more of a refi shop will probably be a little faster to cut staff, but really it'll come down to the profitability of the company, and that is the CEO or the owner's role in all of this, is to make sure their company survives and does well. And if they've got to cut staff, which we all expect at some point will happen, they're going to do it. And good leaders, it's easy to hire, it's easy to staff up. It's tougher to cut staff and have that discussion with an employee, especially if you never met them.
Hey, Rob.
Go ahead, Mike.
So, last cycle, when refis started to fall, you saw a lot of folks cutting back their call center operations, their consumer direct channel. Is that your expectation this time again? Is that the first place people go?
Yeah, well, I mean, that's just my opinion. Yeah, that's probably.
So what I'm really enjoying about this conversation that both of you just mentioned, and we're going to jump to this other question in just a second, is you're both talking about profitability. So often in this industry, you hear about volume, but volume doesn't mean profit, right? Volume just means volume. And so I love that both of you are focused on profit, and everyone that's listening. It's very important if you're going to build a healthy business, a business that can scale, that can hire without needing to fire. I've spoken to so many wonderful CEOs. They're like, no, we're not firing anyone. We're a healthy, profitable organization, and we're going to take the team that we have here and we're going to drive this into 2021, 2022, 2023. And everyone that's losing volume, we have the manpower to increase our volume. And they're taking this opportunity and they're building forward, which I think is great. And you're talking about profits, and that's what it takes, everyone that's listening. That's what it takes. You can't just focus on volume and then when things change, have to start laying people off and laying probably amazing people off. You want to keep your talent. You want to keep the team that you have, and you want to grow on top of it. So think profit, not just volume. And so look, Eric, sorry, real quick, Rob, Eric and Lawrence asked great questions. Eric and Lawrence, we're going to get to them. Let's ask this question that's here. I know, Rob, you're about to mention something about what I'm saying, but I wanted to get back to this one as this is kind of what we're talking about anyway. But go ahead, Rob. What were you thinking?
Well, I was going to say that when you talk to a CEO or an owner of a company, and you say, all right, would you rather originate one loan for $500,000 and make a point on it, or would you rather originate 5 $100,000 loans and make 20 basis points on each one? They will inevitably say, I'd rather originate one and make a point on it. Profitability is very, very important. And Mike mentioned the MBA Strathmore peer group meetings that are actually just wrapping up this morning, and the ability for companies and individuals to look at the metrics. It's very, very important. You can't change what you can't measure. A lot of people like to say, and I think it's important to be able to measure. And in fact, I'll finish up with, sometimes I'll be talking to a manager, and I'll say, oh boy, I hear you lost your Houston branch. That's too bad. They were doing a lot of volume, huh? And more times than not, that manager will say, well, yeah, volume's one thing, but you know what? When you look into the numbers, they weren't profitable. And so that Houston branch or Springfield branch or whatever branch, they look at the profitability and they say, we're not so sorry to see them go, because they weren't profitable. Yeah, they did a lot of volume, but you know what? We had a lot of extensions. We had a lot of price concessions. They were originating bond programs that we sat on our warehouse banks for months. I mean, whatever it is, companies, it's really important to be able to measure what's going on in their companies. So,
and I think that's very important. Look, we're talking about an unforgiving industry. That is part of it, guys. Like, look, here's a shameless plug, or plug, however you want to call it. Profitability is very important. I just sat in on a presentation from MongoDB. MongoDB is a huge organization, worldwide organization in the tech space, and talking about how they have, for themselves, you've seen the numbers out there, but for themselves, they say, hey, it literally costs us 5x more, 5x more to get a new client versus getting an existing client to do more with us, right? And so from the sales Boomerang standpoint, the most profitable deals that exist are the ones that we're going to get to you from your database. They are the most profitable. We need a great mix of new business and existing customers coming back, referrals, repeat business, recapturing. You need a healthy mix of that. And this kind of ties into this question of how can lenders increase their volume and keep these levels up. It's a combination, right? You need a combination of recapture, repeat, and new business, purchase and refi. Rob talked about this before. You want both. You don't want to just be one trick pony. You want to be able to offer everything and have good people on staff to offer that. Anything you want to add to this question here? And I do want to get to some of those other questions from the audience, but go ahead, Rob.
Oh, to this question? Well, but you had a question from Alex.
There is a question from Eric. You want me to get to I can get to the audience questions real quick. So Eric is asking, let me share this because you guys are super active. I love all the questions that are coming in. When spreads margins continue to be squeezed over the coming years, do we expect a reaction in the form of cost reduction, merger acquisition activity, technology investments? Is this a 2010 to 2012 repeat? And that's a lot of things to answer there. So anyone jump in with some thoughts. Mike,
you can start with this one.
So yes, I mean, I think, let me just focus on the tech side of things. While we did see more lenders do things like go to a full electronic mortgage process last year, we heard many others saying, yeah, that's something we want to do, but we were too busy. Couldn't take the plunge. But I think when you're in this kind of environment of volume falling off, margins tightening, all of a sudden that thought of you could shave a few dollars off that cost we originated by moving in that direction, I think those kind of changes are going to be more frequent. And then obviously we talked about the IPOs in the space, but just this past couple of weeks, Rob covers it in his newsletter, a ton of M&A activity. And I don't think we're close to done yet.
Yeah.
Yeah, I agree with Mike. The in the simple, looking at it very simply, if we've got Alex's mortgage on one side of the town and Mike's mortgage on the other side of the town, and you really don't interfere with each other, and you both get along, and there's a cultural fit. I mean, there's no reason that you both need accounting departments. There's no reason for you both to pay vendors whatever the vendors monthly charges. There's no reason for some of the cost, some of the expenses. So why not merge if there is a cultural fit, and that's a big if. But culturally, if there's a fit, then you only need one accounting department, and so you can save money. On the bigger scale, there's huge gaps in products or channels. Big companies out there may have correspondent, maybe they don't have retail. Maybe there's a big retail company that wants to pick up a correspondent division. There's a lot of chatter out there, and I think it is because of the exact things that you're talking about here.
Yeah, no, I love all of the things you guys just mentioned there. Great questions, by the way. Now, look, we have reached the end of our conversation here. There's a lot more questions coming in. I would love to sit and answer all those. Richard, I think we should save those questions, shoot them out to Mike and Rob. I think they're excellent. They're really, really great. And we didn't even get to cover all of our own questions that we put out there about winning in this unforgiving market and the double waves and all of those good things. But you know what? This was an amazing discussion. The audience has made that clear with the questions and the participation. And this has been excellent. I know if I was sitting in the audience, I took really, really careful notes. You guys have mentioned a few things that I should be arming myself with. Number one, understand the data. Rob, you mentioned this. Mike, you talk about it. You live it. You're a data junkie, as you mentioned. It's like, know the data, know your data, know your competitors' data, know the industry's data, know your data. And the other thing that we heard said over and over again is profitability. Focus on profitability. Think about profitability. Live in that space. Understand. Make sure that you're investing in things that are going to help you be more profitable, help your team be more profitable, because profitability is health. It's healthy, right? It's like going to a doctor and getting a clean bill of health. If you're profitable, your business is healthy, and you're not one shake up in the industry away from closing doors and letting everyone go in your company, right? So there was a lot of amazing things said, but those key takeaways I think are fantastic. And look, we'll end it there. Mike, any closing words you want to share?
Just good luck to everyone. This is going to be, as I said, a year of transition. Hope everybody rides through it well. And again, farewell.
Excellent. Rob?
Mike, I think you took those words out of a landing craft in D-Day. It's going to be a year of transition. Good luck out there. I will. I'll just say thank you. I enjoy sharing the stage with Dr. Fratantoni. He knows what he's talking about. He's got a great staff, and hats off to Sales Boomerang with the advances you've made in that space. It's just been great. So thanks for having me.
Thank you so much. I actually am just honored to be on the same virtual stage as both of you. It's really something special, and to hear you guys talk. And those of you that are watching don't know this, we've spent a couple of times talking together and getting to know each other and preparing for this. And the relationship between Mike and Rob is special in the way that they communicate, and it's just really cool to see them go back and forth. So it's really, really fun. Everyone, thank you so much for being here. The audience was huge. We really appreciate you guys coming. I think we're gonna have to do this again, guys. I mean, this is the audience has spoken.